Testing, testing, 1, 2, 3. All right. Good morning. How are you guys this morning? Sorry for being a couple minutes tardy. Had a disaster in the kitchen trying to make my nice warm tea, and I spilled it everywhere. So had a little cleanup there. But look at these markets. Holy cow. Before the morning bell goes off here in how much time have we got left? 28, 29, a minute and 10 seconds. It's a minute and 6 seconds, and the bell to go off. Look at this thing been trading pre-market session, been dropping like a rock. Just a major, massive blow off. Well, let's take a look and see real quick. Yeah, I'm making money hand over fist on my puts. I guess that's good, right? Not good that the market's fallen, but if you knew, or nobody knows, but if you anticipate that's going to happen, then buy some puts. Away they go. Shoot to the moon. All right, guys. So today I got a pretty exciting class for us. This is a class where we're going to learn a little bit more. We are still on the options. We're going to talk about options again today, and I got some options for us to learn. And so we're going to learn about some vertical spreads. All right. What is a vertical spread? How do you trade a vertical spread, Lan? What's a vertical spread? Sounds scary. It's not. It's simple. Once you understand that you can buy a call and you can sell a call, you can buy a put and you can sell a put, and you understand the rules of those, everything else is easy. Everything else is easy after that. You know, we all get tied up, worried about, oh, is it a condor? Is it a butterfly? Is it a vertical spread? Is it a bear call spread? Is it a bear put spread? Is it a bull call spread? You know, you get worried about all the names. Is it a straddle or strangle? Don't worry about all the names. Just understand the concepts, and the names are secondary. Boy, look at that rebound on the Dow. Rebound on the Dow. That's the opening bell. Morning's the day has begun. All right, the day has begun. So let's shrink this down. Let's just watch these markets for a minute. Oh my gosh, look at the Dow. Holy cow. Lost all this all the way down. $355 move for a $1,000 investment. It's already back $335. Come back the entire distance in 2 bars. Are the other markets going to do that? Looks like the Russell's trying to pull back, but it's not. We got the NASDAQ that's got kind of that little pullback. Looks like it wants to rally too, but not nearly what the Dow's doing. Holy cow, look at the Dow. That's unbelievable. It's fun to watch these ponies in the morning, isn't it? Look at these things go. Let's get my face out of there. There we go. Make these charts a little bigger. What are we going to do on that Dow? That Dow will probably flush now. It'll probably come up here, and because of such an explosive growth, all these profit, there's going to be profit taking in here. So you watch, it'll be right back down here in the next 5 minutes. It'll be back down where it was. Why don't you take a short position then, Lan, if you're so confident that it's going to do that? Because I'm not that confident. Just seen it happen a million times, and so you kind of think, well, that's what it's going to do again. Oh, there goes the Russell starting to follow. Is the NASDAQ going to follow? That's the question. We're looking at the S&P. It's on a 15-minute chart because we're going to put some options on that one. Look at this thing. It looks like the NASDAQ wants to flush. That's a flag right there. And it's very indecisive on that flag. Let's bring that thing up a little bit. It looks like it wants to break out the bottom of that flag. Look at it go. And it's a big market. The distance from that tail to where it's at, that's $240. Remember, this whole thing was $400. That thing's one little bar is $240. Keep in mind how big that NASDAQ is. Sure nice when you catch one, because boy, it makes your money fast. But if you're wrong, it rips your wheels off really soon, really quick too. These markets can really rip your wheels off if you don't get on the right side of these things. You got to be careful. Watch this morning bell. Watch what happens here. It looks like it wants to break out the bottom of this triangle while the other market's going up. That's not usual. We want to see these things all go do the same thing. When you got them going like this, that's a lot of indecision. We don't know what to think about that. Coming down, test this low. Now it looks like looks like it wants to rebound off of that. Is it going to break and hold below after that big long downtrend? And this market's coming all the way back to the VWAP. That little blue line, that little magic blue line. Remember, that's a rubber band. It pulls the market back to those levels. And then sometimes it shoots past it, and then it'll pull it back down to it again. So here's the Russell coming in across the top of that VWAP, using that as resistance up in there. A lot of people think that VWAP's important, so that's what makes it important. Most people, when they trade, they don't watch all four indexes at the same time. They pick their favorite. They'll say, oh, I just want to trade the Dow. Oh, I just want to trade the NASDAQ. And so they'll pull up the NASDAQ, and then they'll pull up all the different time frames for the NASDAQ. They'll have a 1 minute time frame, a 2 minute, a 5 minute, 15 minute, 30 minute daily chart, whatever their time frame favorites are, and they'll watch just that one chart. And they don't watch all the other charts and see how they work. It's called intermarket relationships, right? And so by watching all four charts now, the disadvantage of that is that we only have one view. We don't have a longer view. We don't have multiple time frames that we can watch because we're stuck looking at the four markets on all the same time frame. That's why you have a second monitor. So you have a second monitor that's got your individual different time frames on it if you want to watch different time frames. And that's why you would have a third monitor or a fourth monitor, right? How intricate do you want to get with your watching the different time frames? At some point, it doesn't help you to have all those extra monitors and all those extra screens. It's hard to keep them all going in your head at once, but it is helpful to have more than one. Unfortunately, here on YouTube's, we can only project one at a time, right? We can only project this monitor, not that monitor. And this monitor over here, I don't even have for myself because that's where I've got to have all this YouTube projection stuff. So we're kind of flying a little bit with one hand tied behind our back, but that's okay. We can deal with it. So this market's already started to come up and rally. It's starting to die a little bit right here. We see the NASDAQ still trying to hold. It's got lots of topping tails, lots of bottoming tails. And so it's waiting to make a decision on direction. It looks like it wants to be bearish. The Russell's still trying to rally. Russell's still trying to rally out of that little hesitation right there. So we got a little flag formation on the Russell right here. We got a little inside bar, higher highs and higher lows, lower highs and lower lows, and then it started to rally once again. Now this one here made low. It looked like a little flag, but lower highs and higher lows, but then it broke lower. So that Dow broke the flag to the downside. So we have two pullback bars. The question is it going to continue to rally and go higher at this point? The Russell's the leader to the upside. It's still moving higher. So we want to see this thing stay above that green air, those green dots, and break a new high to the upside. If it does that, you could anticipate that the market's going to try and break above that VWAP and run one more time. You could put a small order on there. I wouldn't get all crazy because it could flush. Like I said, I was expecting this thing just to flush right back down. That's what it does. Oftentimes you'll get that big run up like that, and then it dumps right back down. Okay, we're in a flag, and we're in a point of decision. If it breaks lower, you take a short. Oh, that's not what I wanted to do. Already this morning, Lane, you're getting one short, one long. We'll take whichever one goes. And the worst thing for us to do is if that market just died, which it very well could do. If we look at the news, there is none. Lane, you always trade the Dow and you always lose on the Dow. How come you keep trading that stupid Dow market? Why don't you trade something else? I like the Dow. The Dow's been good to me in past times. But it's not been good to me recently, and it's not been very good to me in these morning sessions. Okay, we broke to the upside out of this triangle formation. So what I'm going to do is I'm going to put in a reversal order in case it wants to flush and go the other direction. Still a little bearish on this thing, thinking it'd probably come back down the bottom, but the signal, you have to trade the signal. What signal it gives you? It gives us a signal to the long side. Okay, it's testing that previous high. What are the other markets? It looks like the NASDAQ wants to break higher too. We're going to go in and put on some option spreads here in just a minute. So vertical spreads. Vertical spreads, Land. What's a vertical spread? What's a if there's a vertical spread, does that mean there must also be a horizontal spread? There is. Are we going to do any horizontal spreads? We are. Today? No. We're going to do vertical spreads today. We're going to see if we can't make a little bit of money on this break. Come on, buddy. Now it's starting to wimp out on us. Was going to hold my stop out a little bit, but we'll see what happens. I want to see it get a little, it's wimping out on me. So it's not able to break that high. It's got to hold above that high right there, and it's not doing it. It broke above it and then failed. So it wimped out. And the NASDAQ never did gain any ground on us, did it? Come on, wimpy, wimpy, wimpy. Push up there. It went so crazy out of the gate. You'd think it'd have a little energy to go up one more. Got to that VWAP and was like, nope, all done. Come on, guys. Go read the manual. It says if it break above the VWAP, you go long really hard. Go read the manual. Come on. The traders haven't read my manual. Oh, it's going to fail on us right here. We're going to have to reverse our position and take a short. Come on. Now we're short one. Just reversed. Should have gone with two, huh? To the short side. Being too cautious. That's okay. We got our stop almost to break even. That was a very small loss. Taking a reversal on this thing. The worst thing for us now is if the market just went sideways and started bouncing back and forth, which that NASDAQ looks like that's all it's doing. Oh my goodness. I'm not going to get caught in a reversal again. You know, and then as soon as I don't do it, that's when the thing shoots off to the moon. And you've seen that happen to me a dozen times. Start playing the reversal game back and forth, and it just kills me. Okay, sit out for a minute. Got our hiney handed to us. We got spanked. Market spanked me. Now it's trying to go long again. Came down, flushed everybody out with that clearing bar. Now it looks like it wants to go long again. What a dirty trick. Clearing bar is a bar that has a long tall tail and a long bottom tail and breaks the previous high and breaks the previous low. And it does that just to clear out all the stops above and all the stops below to do just exactly what I had done, just to clear out everybody who had done just what I did. So I wasn't the only one doing it. It's what everybody did. And so they saw that and they cleared out both stops and limits. And then the next bar is generally the trend, because at that point it becomes a neutral equilibrium, right? There's no longs, there's no shorts. They've cleared them all out. And so then the trend can begin again. And then the new trend is the direction. So we should be long at this point once again, but that dirty trick got me. So we're going to watch this NASDAQ. NASDAQ's trying to break out. I want to get in right now in anticipation of a break of those green dots, but that would be a dangerous move. It'd be trying to catch the first breakout, and I want it to prove to me that it's going to go first. So I want to see it come up and then give me a little pullback, little flag, and then get in. So if it doesn't rally and give me a break to the upside, I don't want to do it. So we got our horizontal line across here. We kind of got our line in the sand. Has to break above that, hold above that blue line. That stupid Dow took me out, took me for a ride. Guess I should say that smart Dow. So it's got to break above and hold. See, that's why I didn't jump in, because it's not proven strength in here. Even though the Dow's rallying, that NASDAQ should follow. Okay, we got a flag over here on the Russell. What's the Russell going to do through this flag? Is it going to break out to the upside or break out to the downside? Looks like it wants to break to the upside. There it goes. It's breaking that natural trend line. But is it going to be a fake like the Dow did to us? Look at that Dow go. That dumb Dow knocked us out just as it wanted to turn and run once again. I hate it when that happens. Okay, watch that Russell. Oh, look at the NASDAQ. See? That NASDAQ, the reason we didn't take that long position, because if it had taken that long position in anticipation it was going to follow the Dow, it's flushing down. Now, a lot of traders will take a long position right here, actually, because this might be a touch where it comes down just to take out all the lows right here. See, I broke that low, come down, take that liquidity out, all the stops that are sitting down there, and then turn around and start to rally once again. So this is you just put your stop right here at probably 18,825. So let's go ahead and do that since I might have already. We'll take one right now. Let's see if it wants to rebound for us. I feel bad about that Dow. Oh, look, there goes our Russell. We're over here playing this reversal on the NASDAQ. Come on, NASDAQ. Oh, this is a 2-minute chart on the NASDAQ. It's not 1 minute. If it comes down, we'll touch it again. We'll take a second one down lower, but it's pulling back for us now. That stupid little Dow. We had our money back there on the. I just wanted to play catch up. Well, I'm missing everything, huh? We should have been long the Dow here and long the NASDAQ. Hopefully you guys are doing better than me this morning. See if we can't get one more in on the NASDAQ if it pulls back here and then anticipate a reversal. Of course, watch it flush. Just because lands in it long, when all the other markets are going long, this one's going down. So it'll flush. What's it going to do? You look back in time and you're like, you look at that market, you're like, how in the heck did I lose money on that? I've been there a million times. Hindsight's easy. Getting into these little babies sometimes not so easy. Once we can get into a trend, then it's easy. It's getting in. It's a problem. You don't want to take a big risk in the beginning because, heck, how many times have we seen it just turn and go the wrong direction from what we thought it was going to do? So you don't want to take a big risk up front in the initial. So you want to take a very small risk to get in, and then once it starts to move in your favor, then you want to back off and let the market run. Scalp and trail. This thing down here is not making me very happy. It's just sitting here. Doesn't want to move one way or the other. I thought it might come down, break these lows, and turn around and rally again. It's flagging. So if it breaks that flag, that would be bearish. But we're playing the 2-minute chart here. See the little flag right there? That's a downside flag. We're long. But all the other markets are going up. So tech industry is going down while everything else is going up. Come on, guys. There it goes. Put on a second one as it broke that high right there in anticipation of breaking that first high. We got our money back. We're up over 80, which is what I wanted to do initially. But if we hung on to it, the question is, do you want to get your money back? You want to hang on to it and go see if it's not going to go? And we should have got our money back. Should have put a limit order, take our profits, and just get us back to green. Now look, we're too short, and we're going to double down on the short. Ugh. Can't do it. Can't do it. Broke it again. It's just sitting here dilly-dallying around. Yeah, let's break a new low. See that the NASDAQ, that's a nasty bugger. Look, we're down $570 already. I told you, if you catch it, it's great. But if it takes you back, it takes you out. It rips your wheels off fast. Learn from my mistakes. That's why you're here, right? Man, look at it go. Broke that natural trend. Look, man, that little down, it's flushing. That would have been a nice trade to the other side. But I thought we were going to follow the Dow. I thought it'd follow the Dow and the Russell. I thought it would turn right there, catch that liquidity, and shoot out the top. Didn't want to do it. Broke that natural trend line, little trend line right there. Decided it wants to go lower. Well, not doing so good this morning. Missed my Dow run, missed my Russell run, and picked the wrong direction on the NASDAQ. We need to slow down for a minute. Just wait. We need to go put on some vertical spreads. Maybe if we'd have trading this with vertical spreads, we'd have been doing better, right? Let's go say hi to some people and see who's in the house. You guys want to say hi today? You got a lot more people in the room than what we got saying hi. You guys want to say hi? We got Selena Pavlek. Good morning, Selena. It's nice to see you. We got Larry McIntosh. Larry, we got class tonight at the university. I saw you registered. We'll see you down there. Small class. They accidentally left this class out of the book, out of the catalog. So there's only a few of us in there, but we'll still have a good time, and we got a lot to learn. And then we'll come and use this platform here as the lab to follow up. So any of you guys who want to come and participate in that, you'll learn a little bit about what we're talking about in class. We'll start that tomorrow. All right, Bruce R. It's nice to see you, Bruce. Gary, nice to have you. Matt, good morning, and all. Happy Monday. Happy trading. Matt, it's nice to see you. Did you catch that, Russell, Matt? Oh, look, the NASDAQ's starting to rally over there now. So Kirk Schwartz, good morning, everybody. Bruce Merrill, Nice to have you, Bruce. Good morning. Took a bit of a risk and played the reversal on the S&P 728. Wrote it up for $500. The S&P rally. Oh, good for you, Bruce. Nice job. That S&P, I've got it on the 15-minute chart because I was going to put some options on it. Let's go look at it on a 1 minute. Oh, well, Bruce, you made the right move. I thought that was exactly what we were going to see on the NASDAQ, and it didn't. And the fact you caught it over there on the S&P, I'm pretty proud of you. Way to go. Good job. Rock Steiner. Hello, Rock. It's nice to have you. Steve Scott. Good morning, Len. Great class. I appreciate that. It wasn't too great this morning on the trading. Getting my hiney handed to me. Maybe we can get something here. The NASDAQ's trying to rally again. Maybe we can see it turn for us. Maybe we'll bring that to a 1 minute chart time frame. It's starting to move a little bit down here. It's just lazy, being lazy. Let's see what happens. The Dow's getting a little pullback in here. Now, we don't take that reversal position. Not that it can't reverse. It certainly can. Put your Fibonacci ruler in here. See how far back you think it's going to go. Usually this market will drop back down into this Fibonacci sweet spot, decide what it wants to do, and then if it's going to continue the rally, that's where we get that pullback out, right? That NASDAQ's being a little bit friendly now. Had that false breakout to the downside. Look, that was where we were trying to get in long, and it went and broke us out. Now it's turning in a rally. Same thing that happened to me up here on the Dow. Faked one direction, went the other, just like a good running back in football. Fakes one way, goes the other, and then fakes you out, takes you with it. So there's our Russell 50% retracement. Let's replace that. Let's make that a Fibonacci ruler so we can see. Fibonacci ruler from top to bottom. See if it won't come back down into this Fibonacci sweet spot right here. Okay, we got 4 bars on the NASDAQ. Let's look for a flag. Maybe we can get the NASDAQ to work back for us. Okay, here we're looking for a flag. So let's see if it wants to break for us right there. Look, all the other markets are falling. NASDAQ's starting to try to rally. What the heck is going on? I'm good at picking the wrong markets today. Bruce says he rode that thing all the way up $1,000. Sweet. Nice dot. Nicely done, Bruce. Coming back down into the sweet spot. Here it comes. Look at that. Russell coming back down into the sweet spot. Coming down faster than I thought it would. So we got a red arrow down. We got a yellow arrow down. Yellow arrow came in first. So that was just oftentimes we don't take because we got the red arrow right here, right? So this is our direction, trend direction. This is our trigger for entry. So if this was long right here, this says long, we don't take the first short on the red yellow because oftentimes that'll just be a quick reversal where the market comes down, turns and rallies once again. But where we got the reversal arrow now saying we're red to the downside, now coming all the way back down into the sweet spot. All right, let's go put on a vertical spread. What is a vertical spread, Lan? Let's go put one on and then we'll talk about it. Come into our options chain. We're going to go to 0 DTE. It's just going to expire today. And it's staying below the VWAP. So we're going to put on a bear. No, we're going to put on a bear call vertical spread. Bear call spread. All right. It's a bear, meaning that we expect the market to go down. We make money when the market goes down. That's what the bear means. We're going to put on a call, means we're going to use call options to do it. And then it's going to be a vertical spread, meaning we're going to sell one and we're going to buy one. So we're going to sell a call up here. And that thing says, we'll put it up here at $85. And then we'll buy one. That gives us a huge margin. Look at that margin requirement, $12,000 to do that. So we're going to buy an insurance policy up here, a couple clicks out, spend some money on insurance in case we're wrong, $37.50, and our margin goes all the way down to $220. So now the way we make money, it's not going to be very much. We might want to do a couple of them. Give us up to, let's put $1,000 on. So there's margin requirement 1,100, same as a contract. All right, we're just going to mark it into it, get this thing on there, start losing some money. Now, the problem is that we put this on while the market's coming down. And that's not optimally when you want to be putting on options to the downside. You want to be putting them on when the market's coming up towards them, right? Because then the implied volatility is going to be very high and you're going to get a lot of money out of it. But the market turns started to fall, so the implied volatility fell out of the bottom of that thing already, and so we're putting it on and we're not getting very much money for it. But we're paying $100. We're going to receive $400 and we're going to pay $175 in insurance. So 400 minus 175, a little bit over. It's easy. $300, $325 if this thing plays out all the way till the close of business. Now, if you don't want to wait till the close of business and you're like, well, I would be happy if the thing just made me, a couple $100 or $100. You come in here and you go liquidate multi-leg, and you come in here and you set it up and you say, I'm going to receive, going the wrong way. I'm going to receive. So right now it says I'm going to pay. So I'm going to receive. Oh, that's not the way it works. Net profit, 100. And if we just put it on $100 right there, net profit, 44%, $100. And we're going to have to pay them back 125. We place our order. And now we got a limit order in there. And as soon as that thing makes $100, it'll just pull it off the table. So as long as the market stays below that, right now it's a yellow line, but that's because we have a limit order on there. As long as the market stays below that yellow line, you'll be making money slowly. I mean, especially if it turns and starts to rally, then it's going to start to lose money. But as long as it stays below that yellow line, it'll make money as this thing time decays. And as soon as it time decays $100, it'll automatically pull it off and give it to you. You'll be done. All right. So that's the name of that game. That's a vertical spread. Let's go pull up let's go look at the news here while we wait for that thing to do its thing. And we'll watch it here. Monday, 8 a.m. So right now we've got factory orders month over month. Oh, look at that. The forecast was 2.3, minus 2.3. The consensus was minus 2.8. The previous was 2.8. And the actual was minus 3.6. So factory orders way down from even what they expected. They expected down 2.3. Consensus was down 2.8. Previous was up 2.8. Now it's down minus 3.6. Wow. Factory orders, transportation. The forecast was 0.3 positive, and it was down 1.2. So that's all bad news. And at 9:30, we got these things coming in. That's not going to do much for us. Tomorrow, we've got PMI at 8 a.m. and jobs coming in tomorrow at 8 a.m. So tomorrow will be an active day around 8 o'clock. All right. So all we need is this thing to continue to fall. We're up $25. Oh, just dropped to $25 on this thing so far. We just need it to fall a little bit. We'll go a little bit further. This is a little bit slower accumulation. It's not as fast as trading the outright contracts, obviously. It takes longer because you're just taking the time decay. Should have been in there a little bit sooner as that thing rolled over and give us that red arrow. That would have been the optimal point. Well, actually, the optimal time to put it in was in anticipation of the reversal up in here before it does that. But that red arrow is a good place to be putting it on. It's already turned and implied volatility is already turned against you, but you can't be perfect on these things all the time. So We just wait for it to decay. Now it's back to nothing. 1250. So the market needs to drop. That bar right there. See how that longer bar caused the implied volatility to jump up for us? Now it's turning around, and see how that affects your price? Just be very mindful of how much every little move in these markets affects the price of options too. So now if it starts to rally, we'll start to show a loss. But as long as it stays below that, right here was where this thing was trading. So as long as it stays below that line, we'll go to a 15-minute chart. Got to just stay below that line. Hit that purple line before it hits the yellow line, and then we'll make our money. That's kind of where we're at right there. Now, if it turns and rallies all the way back up in there, you start feeling bad. You can do what we call a roll. You can do an options roll where we roll these out a little bit further. We sell these and buy further ones out. This thing on the 15-minute chart's making a little flag in here. So we got a little flag happening. So we want it to fall out the bottom to keep these options profitable. The other thing you can do to mitigate this, if it starts to rally again, what can you do? Does this look familiar to you from what we talked about last week? Does it look familiar? It's one leg of an iron condor, right? So if we wanted to, if this market starts to go up, we could put the other leg of the iron condor on down here, and that would mitigate the losses on this one, or help anyway. This is just one side of an iron condor. That's all that is. That's the bear side of the iron condor. The call, bear, because we're bearish, right? It's the bear side. So it's the call side of the iron condor. And that's going to move slowly now because we're on a 15-minute chart. Now, you can still come over here and trade other things while you just kind of let time decay over there. Or you can just be happy letting time decay. Bring this down a little bit. Open our charts up. We'll leave that running so we can watch it down there. And then we can still trade a little bit here if something happens. This NASDAQ's just being lazy dead. That's 1-minute chart, and it's not doing anything. It's doing its little pullback. Oh, while we're gone, there's the 4-bar rally. It came back. I was looking for it to come back. It didn't break the yellow dot, green dots. There's our green dot break, but it only went 2 bars, 2 flat bottom bars. It's trying to go long again right now. See if it'll pull back. I really want to get long on that NASDAQ. I think it wants to pull back to the blue line. I think that's its goal right there. So we take one long in anticipation just in case it wants to go off this break right here. There's a second. We'll take a scalp in here just to see if we can't scalp a little as it tests that previous high. And then the other one, we'll see if we can't get it to run. Scalp and trail. There goes the Dow trying to break that green dot to the upside. We're just taking this little hesitation in the trend here on the NASDAQ. Let's see if it holds. Doesn't come back and nail us again. So we want to take a little bit of profit just to kind of scalp some out. It's going to fail on us already. Oh my goodness. I am not having a good day. Failed. Failed to push higher. The The Dow's trying to break that right there at the 61.8. Look at that. It came right down and touched it. Anybody who tells you Fibonacci doesn't work, they don't know what they're doing. They don't know how to measure Fibonacci. I was watching a kid on YouTube over the weekend, and he's like, them Fibonacci numbers, they don't work. Let me show you here. And he tried to draw the Fibonacci rule, and he did it all wrong. I'm like, well, the reason it doesn't work for you is because you don't know what you're doing. And it's a very simple process. It's a tool that you measure waves in. And he's like, doing it all wrong. I'm like, what? Why does he have 125,000 people watching him do the wrong thing? Okay, here we go, breaking longer on the Russell. Maybe we'll try and get in on that break right there. Should we take that Russell long? Right there, it's trying to go. Do a scalp and trail. Let's try and take a quick scalp, cover our costs, let the rest run. There we go. All right, we're going to put this one here, edit, and we're going to trail on ATR this time. Just let that thing go. So we took just a quick scalp out of there just to see, to cover our costs. Being cautious because this I can't catch a break. Not even our vertical spreads making money for us today. Fibonacci doesn't work. You know, good. I'm glad it doesn't work for you, so I can take your money. Now we're getting a little flag in here again, right there, off of that Dow. Trying to cross over the 21 period moving average. That's oftentimes a resistance point. So there'll be guys who will take short positions right there. As it touches 21, that's a sell zone for a lot of guys. They'll try and take a sell off of that to go short. So that would be an ABC off the top. A, B, C. It hits the 21. They'll take a short position right there in anticipation of a fall. That would not be good for our Russell if it does that, because the Russell would be going this way, up, it's breaking that 21, and then it would turn and fall. Russell's trying to go, though, because our strategy on this one is the long side, right? We're looking to go 1, 2, 3, come back to 61.8 right there. And it's being lazy. It's not taking right off like a rocket ship, but that's okay as long as it goes. Okay, we're bouncing up here off that. Let's get rid of some of these drawings. On the Dow, it's hitting that 21 period moving average right there where the VWAP is too. So this is a strong area of resistance right here. Look at the stupid NASDAQ. That's the one that ripped our wheels off again today. We didn't do too bad on the Dow. We took a couple bad hits, but they weren't bad. We're only down a little bit on that one. It was when I got in and took those positions on the NASDAQ that destroyed my count. Well, the Russell's slowing down on us too. There, see that's bouncing off of that 21 period moving average. Man, you're making just a comedy of errors today. Got in on the wrong market. We'll make it, see if it won't pay off for us. Okay, I'm looking for the Dow to drop. Looks like the Russell's petering out on us. I've just trailed the green dots on the Russell, so that'll just go as long as till it crosses the back below the average true range. And I've got it set to 0.9, so it's a little bit more aggressive than just the 1 and 1. We're short the Dow, trying to break this downside. So we're in the down arrow right here, and it crossed the green dots. So I'm going to get it. If it'll hold below the green dots, we'll get another down arrow right here. So I'm anticipating that down arrow on the Dow as it falls out through that Fibonacci sweet spot to the downside. So that's what that is. 1, 2, 3. So we're looking forward to continue that red trend down. Is he going to wimp out on us? Okay, I'm going to hold that back at it. I'm going to put it not on price bars. I'm going to put it on the ATR. And again, on that one, we're just going to trail those green dots down. This is a scalping trail, so we're in short with 2. I'm bringing a little larger screen. Of course, then we don't see what we got going on over on the Russell either. So we're trying to get just a scalping trail here. Have this come down, touch this just before it tests these lows. Take a little bit off. I got that set to trail that green dot. Right now, it's just holding behind that red price bar right there. I want to maintain flat bottoms, flat top bars. If it goes up and breaks it, we'll just get out because it's failing going back to the upside. Yeah, and it's going to fail on us. Don't fail on us. Okay. Lane can't catch a break today. Tiny little position over here on the Russell. At least the Russell's playing out for us. Stochastics is up in the upper region. We're just trailing. We got the scalping trail on this one, so we scalped out a little bit. Our option's up $50. If it'll hit 100, then it'll take it off. Nothing to do at this point but sit back on your hands and watch. If it gives you a little flag and stays above the green dots, we could add in another position. Looks like it's going to flag here. So we got a high point. Let's go look around for a second. There's what we're doing on our option. We're up $50 on our option because the market's still dropping. It's coming out the bottom of that thing. This is a 15-minute chart, so that S&P is falling. See that little, we had that drawn in there before, and it changed direction. We got more data, so that's where our little flag's at. Usually those little flags are just a little hesitation in the trend, and it should fall out the bottom and give us our money on that thing. That Dow, look at that broadening pattern. Those are death to traders right there. That's what those are. That's what those are. Those are death to traders because it's topping tail higher, bottoming tail higher, lower, bottoming tail lower, bottoming tail lower. Look at all those lower bottoming tails and higher topping tails. That's a broadening pattern. Those are death to traders. The reason they're death is because you put your stop one bar back and it comes up and hits that one, then it hits that one, then it hits that one, then it hits that one, it hits that one. That's when you start doing your reversal because you're in a neutral zone, right? And you think, well, I'm going to take the breakout. So guys are waiting to take the breakouts up, taking the breakouts to the downside, and there's no volume in this thing. I'll bet you we got to turn that on. Volume's dead. And so nobody's in there. They can't get it to rally. They can't get it to fall down. It just sits there and knocks back and forth, and you die right there, dead center of the Fibonacci sweet spot. That happens in the sweet spot sometimes. Be very mindful of that. Markets come down, they make their full run up, their full run back down to the sweet spot. This is a indecision point. An area of indecision is in between 38.2 and 61.8. You get lots of traders lose all their money looking for breakouts inside the sweet spot. We should actually call it the danger zone, not the sweet spot. It's actually the danger zone. Let's go see what's going on with the NASDAQ. Oh, the NASDAQ broke out. Finally started to fall. Stupid NASDAQ. That's the one that took us for a ride today. Wouldn't go down. It wouldn't go up. We tried and tried to get into this thing. It wouldn't go. Looks like it's falling now. Take a short position right there off of that little shelf, but I don't trust this rotten thing. Right there would be a short position. Put your stop 1 bar back, and if it catches up, then let it trail the green dots down. But if I wasn't already down so much money, I would try that. But since I don't have any, if I was up a little bit, had some green, that'd be a good one to take to try and get into this longer term downtrend. But where I'm already down so much, I can't take a low probability trade like that. The Russell stopped us out. Okay, we got red bars to the upside. Somebody asked me on Friday, what are the yellow bars, Lan? How come there's yellow bars in here? This is the bulls and bears. I have a bulls and bears indicator turned on, and it's based on Fibonacci. So the reason the price bars are in there like that, and you have yellow bars, is because it's a Fibonacci sequence. See that? And so those yellow bars are calculated to be part of this Fibonacci sequence. So as they come down off of this top up here, anything above the yellow bars is going to be green. It's in a bull trend. Now this went so fast and so far. This one didn't have any yellow bars, didn't even go through a neutral zone. It skipped right past the neutral zone and went from red to green. But usually we'll get a neutral zone, which is the Fibonacci sweet spot, right? So you can see the market came up through this bullish trend, came down into the Fibonacci sweet spot, which is the neutral zone, which is why the price bars turned yellow. And then it broke out the bottom of the neutral zone and went red. Now it came back into the neutral zone. As soon as it goes into the Fibonacci neutral zone, you can see right in there. I'm going to turn off 76 so it's not confusing. So there's your Fibonacci sweet spot right there. See how it's calculated with those yellow bars? And that's what it's telling you. So that's a mathematically calculated rolling Fibonacci sweet spot. And so when it's inside of the neutral zone, it's in the Fibonacci sweet spot. That's why it's neutral. If it breaks out to the upside, we'll throw an arrow. The bulls and bears throws an arrow and tells you that the market is now bullish. And that's how you determine whether market's bullish or bearish. We got too many. Let's just do 21. We don't need to. We'll turn that one off because we got too many tools telling us the same thing. All right. Okay, so what we've got is we've got a Fibonacci sweet spot. That's what that is. So you don't have to draw your ruler all the time. That's the whole idea. It's like I don't have to sit there and draw my ruler from top to bottom and then bottom to top and top to bottom and try and anticipate where the Fibonacci sweet spot is of Fibonacci, because it's all just built right into the color bars. So it's just a color bar telling you that you're in the Fibonacci neutral zone. If it breaks out the bottom of the Fibonacci neutral zone, the bulls and bears indicator will give you a down arrow indicating that the market has changed from bullish, neutral to bearish. If it does it the other direction, see, it's coming in out of this neutral zone right here. So it dropped out of this neutral zone, went red down here, and then it turned and started to go back up, and then it went back into a neutral zone again. So it went into this neutral zone, and then it broke out the top of that neutral zone. So the bars turned green, and that neutral zone is just the Fibonacci sweet spot. That's what that is. So if you take your Fibonacci ruler and draw it over the top of the market, you're going to see that that yellow zone is right dead center of your Fibonacci sweet spot. Okay. So it's just so you don't have to draw your Fibonacci ruler. And you can turn that on and off. You don't need to leave it on all the time. Only when you're calculating Fibonacci. Turn it on, turn it off. There. Now Fibonacci is gone. You're not calculating Fibonacci on the fly. So now you need to use your hard ruler and come in and say, okay, where is the Fibonacci sweet spot? So it depends on whether you want help mathematically to tell you where the Fibonacci sweet spot is or not. So there's your Fibonacci sweet spot. It tells you where the neutral zone is. So if this is a big, long neutral zone, you can anticipate. You can say, okay, from here to here, there's the neutral zone. If that's the neutral zone, the market should drop down to about this level here. And then that's where the bottom of the Fibonacci ruler is, because there was the neutral zone. You can just kind of anticipate, hey, there's the bottom of the sweet spot. But you've got to also take into consideration that there's Fibonacci projections. Okay, so you got your display of your projections, and they continue to come down. So these are your projections down into here. Now, oftentimes you don't see me use this part of the ruler in the projections. You see me do it this way instead. So I come in and go 1, 2, 3, and then I get that same thing basically, right? Get that Fibonacci projection off of the previous trend. So that's how that works. So it's all just a mathematically calculated rolling Fibonacci sweet spot telling you bullish markets, bearish markets, neutral markets. And that's what it is. All right. Doesn't mean you can't have a neutral zone in a bullish trend, like right here is a perfect example where this market went sideways and it didn't go yellow. Why didn't it go yellow? Because it wasn't in a Fibonacci neutral zone. So it doesn't go neutral just because the market goes neutral. It goes neutral based on Fibonacci. So Fibonacci sequence. So that's what's so cool about that tool, that bulls and bears. Now, the bulls and bears also has another tool, which is called we call it the blue light, which counts the waves. Okay, so it's a wave count tool. You'll notice it's a lot less aggressive than the green dots. The green dots break more often. The green dots are a lot more aggressive in here. These blue dots are a lot less aggressive. And the reason is because they're counting the Elliott waves. So this is how we count the Elliott waves. Drive 1, we get a retracement, another drive, another drive. So we're in these drives, and that's what these blue lights are. They count the Elliott wave patterns. Okay, so that's how the bulls and bears works, one with the other. So it's Fibonacci and Elliott wave. And those of you who know me, those of you who have my book, you know that Fibonacci and Elliott wave that's the whole world. And so that book right there that you can get on Amazon, just go out and get Lan H. Turner. It'll teach you all this stuff. So it teaches you all about Fibonacci, Elliott wave, tells you how to count the blue lights, how to use the green dots, how to use everything. It's all in that book. So it's out on Amazon if you want it. All right. So where are we at? That was the Russell. There's the NASDAQ. So it did break out that pattern, just like I said, right there. And it flushed down. Had we taken that one, that would have been a good trade for us. There's the Russell. Oh, S&P took our position off. So we made our money on the S&P. Yep, 170 minus 75, there's our $100. Okay, so made $100 on our vertical spread. So that was a vertical spread, made $100 for us because that's what we told it we wanted, right? If we had let this thing go all the way into expiration, it would have done 400, but I wanted to show you how to put on a limit order so you can take it off. Let's go have our little lesson. Let's go quick lesson on putting on a debit spread. A debit spread involves buying and selling two of the same type of options with different strike prices, which results in a net debit to your trading account. Oh, this is a debit spread, but we did a credit spread, which is the next one. Credit spread. A credit spread involves buying and selling two of the same types of options with different strike prices. No, wait a second. When we put that on, was it a debit or a credit? We had to actually pay money, didn't we? So it was a debit spread. So a debit spread involves buying and selling two at the same type of options with a different strike price, which results in a net debit to our trading account. Example, if you buy a 50 call and sell a 70 call, the options bought cost would be more than the option sold. Therefore, there's a cash outlay to put on the position. That's a poor man's covered call is a debit spread. Now, we haven't talked about poor man's covered call. So that one we put on was we sold it for more than we bought. So it was a credit spread, wasn't it? Okay, so this is the one we just put on. A credit spread involves buying and selling two of the same types of options with a different strike price, which results in a credit to our trading account. So an example is we sell a 50 put and buy a 30 put. The option sold collects more premium than the cost of the option purchased. Therefore, there is a credit to the account. This is what I call the chicken wing. The chicken wing is a credit spread. I haven't talked about the chicken wing. I mentioned it, but we haven't really put one on. What we did today was a kind of a chicken wing. All right. So this is what we did today. We did a call credit spread. So what is a call credit spread? A call credit spread is a multi-option strategy where the premium collected is larger than the premium paid. So we sold our call and we bought a call. So that was all we did. We sold one, collect the premium. And in this case, we did 3 of them. So it was $500. And then we bought a call and we did 3 of them, which ended up being $175. So we collected more than we paid. So that's a credit spread. All right. So you collected more than you paid. It's also a bear call spread because we expect the bear, meaning we're going to make money when the market goes down. We used calls and it's a spread. So it's a bear call spread, which in this case is a credit spread. All right. Again, don't get confused with all the names. All right. All the crazy names. So then the next one is a put credit spread. A put credit spread is a multi-option strategy where the premium collected is larger than the premium paid. So it's the same thing. It's in reverse. So we sell one put, 50 strike, buy a put, 30 strike. Okay. So we're selling a put, which in this case would give us more money than the put that we bought. So it's a credit spread. So this is the other side of the iron condor. If we put on this put credit spread and this call credit spread at the same time, that's an iron condor. All right. And if we put those right on top of each other, so the sell put was right on top of the market price at the same price as our sell call, that would be an iron butterfly. All right. Putting a gap between them. So this is all we're doing is putting on one leg. And when you only put on one leg, I call that a chicken wing. Why do I do it like this? Call it a chicken wing because I'm chicken. I don't dare put on the other side. Right. I don't dare put on both sides because the market's going to trend and move. And I don't want to have one side lose money and the other side make money and have to sit there and adjust the other losing side. So rather than doing that, I pick a direction. I say, well, I think the market's going to fall. So I'm not going to put on the lower wing. I don't think the market's going to be neutral and just go sideways all day. I think it's going to trend in one direction or the other. So I only put on one side of the iron condor, the call side or the put side, depending on which direction I think the market's going to go. And then I just collect the premium as the market moves. Now, if I'm wrong, I'm going to have to adjust. And we haven't done any adjustments or rolls, but we'll show you how to do a roll this week, maybe too. But we're going to start this week is we start a new class at the university. So we're going to be doing a little bit different stuff. We're going to be trying some different tools and stuff. The things we're going to be learning this week from the university class is different tools of the trade. So we're going to be learning how to pick the right stock at the right time. We're going to be doing some timing stuff, some tools that you can use to help you time the market. All right. So the advantages and disadvantages of a credit spread. The advantage is that we have a known risk versus reward for both max profit and max loss at the time of purchase. Another advantage is we don't have to be absolutely correct with the market direction. The disadvantage is that our risk is significantly larger than our reward. We can lose a lot more money than we can make. Now, we can move these things and we can mitigate in some degree and try and reduce our losses. But if this thing goes up, we can lose more than we make, right? Your profit potential is a lot smaller than your loss potential. So Nissim T-Lab, I don't know if I'm spelling his name right, but he says, an acclaimed author on randomness and risk, whose book describes the options credit spread strategy, which can have a very high probability of success for a small return or pennies with a very low probability of loss. He calls it the steamroller. He says, trading credit spreads is like picking up pennies in front of a steamroller. So this is his little picture. Trading credit spreads like picking up pennies in front of a steamroller. So what you're doing is you're playing the delta odds. All right. Call and put credit spreads. So we'll talk about adjustments later. This is how you adjust them. I'll leave that on the screen for a second. So if you guys want to jump ahead in class, but that's how you make some adjustments to your options. But I want to show you when we put one of these things on, we can put another one on. Just come in here and we'll we're going to sell a call, and we're going to put it in here to sell it there, and we'll buy a call. And so that's just like a $20 one. That's just a little cheapy one. We'll just throw that on here for an example. But the example is that you can lose a lot more money than you can make. So your loss potential is $153 in this case. You see your little calculator over here on the right hand side. So when we put this thing on, I want to go to, this is calls. So when you put this thing on, look at the delta on this thing. So generally we like to go up into the 80-90% probability on the delta so that we have a real high probability of success. So probability of being out of the money is 87%. That's pretty darn good. 87% chance you're going to make money on this thing. All right. And the call is sitting at 93%, but that's just your insurance premium. Your probability of being out of the money is 86%. So you got an 86% chance this thing is going to make money. But if you're wrong, you're going to lose $153. If you're right, you're going to receive $32. So you got a really kind of a reversed profit loss ratio. But the reason you do that is because of that high probability of success. All right. So that's why he says it's picking up pennies in front of a steamroller, because if you're wrong, the amount of money you can lose is 3, 4, or 5 times larger than the amount of money that you make. So you have to not only play the probabilities, you have to also be good at predicting market direction. So you want to be good at technical analysis. You want to be good at these Fibonacci numbers. You want to be good at being able to determine which direction the market's going to go, and then use these high probabilities in your favor to try and give yourself even that much more leverage in the right direction, and then collect that premium. Okay, so it's the premium decay, and you have a real high probability of collecting that premium. But if you're wrong and that market actually goes the other direction, you can lose 3 times more than you're going to make, and that's why they're a little bit dangerous. But that's the same as if you're going to put on an iron condor, an iron butterfly. You got these real high probability trading option probability points. But if you put them on at the wrong time, you're not good at timing, you're not good at technical analysis, reading Fibonacci charts, knowing Elliott wave patterns, that kind of stuff, putting all the odds in your favor in the first place, and then putting these things on, and then they give you that big buffer. You don't have to be absolutely perfect. You just have to be, this is horseshoes. You can just be close. Not like when we're trading over there in the with contracts. Man, if you're wrong, you're wrong, and it's brutal. It hurts, right? We proved that today. You take a couple of positions in the NASDAQ and it goes the wrong way against you. Man, it hurts. It's painful. But with the options trading, you can be right overall and wrong. I mean, you can be, wrong, wrong overall, but right, and wrong in the short term, right in the long term, and still make money. You can't do that when you're trading contracts. You got to be right. And if you're not, you can get your hiney handed to you. So at least with this way, you got a real high probability of success. The market doesn't have to, all it has to do at this point is it has to stay below that red line, and you get to collect your money. So even if it turns around and starts to wander back up against us, as long as it doesn't ever, go above that red line, you're going to collect your money. Of course, you're going to collect it faster if it just drops. Like it did for us. We just made $100 off our credit spread, just like that, just in the first drop of the market. So that's what a credit spread is. I like them. They're really nice. They're good. They're good opportunities. You don't make a whole bunch of money on them. They're not like killers because they're so far away from the money. Now you can do them closer to the money if you feel more confident. Let's go do one of those and be a little bit more confident in our direction. So let's come in here. Let's exit out of this position. We'll just exit out. So that one's gone, and let's come in and let's put one on with a little bit higher money. Now the probability, if you look at the delta right here, the delta at the money is only 53% of being out of the money, or 46% out of the money. All right, as opposed to 80%. But look at the difference in premium that you get to collect. If you got a right at the money and you sell one at the money, sell call, as if we were doing a butterfly, right? You're going to collect $275, and then you have to have your insurance premium. So you buy a call up here to protect it. And so that's $82. So that means our margin requirement is 91. So we're going to lose 91. Buy a call, sell a call. So we're going to receive 201. Oh, our margin requirement is only 91. They're giving us a good deal. $85 for the call, 298. But that's because we're so close with the money and our probability is only 50% chance of being profitable. So you put that down there. Now all the market has to do is go above that red line and you lose everything. You lose your whole $91. But if it'll stay below that, if it's anywhere below here, anywhere below the red line, you get $202. So that's not the one that's got the real high penny, but it's the probability of that happening is a lot lower. So you make more money, but your probability of success is only 50-50. So you have to decide what you want to do. You want to have that big buffer and not make as much money, or you want to put it right at the money, and they give you a lot better deal. Receive $202. Your margin maximum loss is $91. Your return on your risk is $222, but the market has to stay below that red line. So the closer you get, the more money the bigger risk you take, the more money they give you. Let that sit there for a second and see what happens. Still sitting at 0. Oh, we haven't put it on. I didn't place the order. You want to put it on? Market order. Place the order. All right. So now it's in. And all the market has to do is fall. Now, if you wanted to say, well, if it makes me $100 land, I want to get out. So you come in here, you say liquidate the multi-order. And it doesn't just take it off right now. We're going to set the order up, right? So we're going to come in here and I'm going to tell it net profit. I'm going to run this little bid up thing up until it tells me that I'm going to make a net profit of, let's just say $50. Net profit of $50. That'd be a 22% return. So I'm going to go ahead and hit place order. I'm going to do market order since we're in the demo account. Oh, and it took it off. What? Chart, all chart. I don't know what I just did something wrong. I don't know why I did that. It took it off. Oh, because I did market order. That's why. What am I thinking? Market order. You can't market order into a limit order. Limit order, that's your order for, that was my stupid mistake. Let's put it on and do it again. Okay, we're going to sell a call and we're going to buy a call. Okay, and the sell call is at the money. Let's widen this out a little bit. All right, now we're going to mark it in. So we're going to mark it in, but you can't mark it out if you're going to do this. Now we got to come in and we liquidate the multi-leg and we tell them that we want $50. So you run this up to $50. There's $50. Net profit 28%, pay 122 back because they already gave us 300 minus 130. So we'd have to pay 122 back, but that would leave us with $50. Margin decrease, $66. They're going to margin us at our max loss. Our max loss is $66, and they're going to give us $50. So now we're just going to put that order on, and there it is. There's your limit order, and it's going to hold there until your option makes you $50, and then it'll automatically take it off. Of course, our max loss was $66, which means it would have to go up into here. All right. Well, that's your credit spreads. Credit spreads, debit spreads. Maybe you guys put some of these on and practice with me. It wasn't very clean. Wasn't a very clean lesson. I apologize. I try to use a market order to get out, and that was not what we want to do. We want to use a limit order to get out. So it's starting to move. We're getting a little bit of time decay. We're up $5 already as that market continues to fall against us. All right, guys, how many of you were able to get your Pit News magazine? Did you guys get Pit News magazine? It's a December issue. Was really fun. Hope you guys all have Pit News magazine. Go over to pitnews.com, pick that up, get the December issue. It's got all kinds of wonderful articles in there. It's got some articles about options. Got some articles about recurring price patterns. It's got some great stuff for Christmas in there. It's a fun little tool. Fun little document. It's only $1 right now. So if you guys want that, go get it. It's $1. I don't have my little thing up to show you. Oh, there it is. Use Land Live -$1. Go get the December issue of Pit News magazine for $1 for an entire year. You get the whole year for $1, not just the December issue. get all the issues for the next year. So if you haven't got it, run and get that. It's really cool. It was a lot of fun. It's got a lot of great information in Pit News Magazine. And then Stock Market Playbook of Strategies. If you guys haven't got the manual to the class, go pick that up. And if you guys would, like and subscribe. A lot of people watch this videos. We get a lot more people watch the video than are subscribed. About 80% of people who watch the video aren't subscribed. So if you guys are watching and aren't subscribed, go ahead and subscribe and ring that little bell so that you get reminded whenever we're going to have a new class. And we're going to start a new class at the university tonight. And tomorrow we're going to start learning a little bit more about how to pick the right stock at the right time. And maybe we'll have a little bit better luck day trading than we did today. Today was not a good day for me. But there were others in the class that had a good day. Bruce Merrill wrote it up for $500. Bruce R said he got out with $1,000. We had some good moves in the market today. Kirk says he got the Stock Market Playbook as well. Hope you enjoy it. You learn a little bit more about Fibonacci and Elliott wave, how to count those waves. I've actually got a book on these option strategies, but I haven't published it. I use this book. I make no money off this. Trading commodity options with creativity by Carly Garner. That's a really good options book. Carly Garner. I don't know if you can see it, but really big book. Lots and lots of pages. Lots and lots of pages. Makes for a good book. So that's the book I use, but it's like an encyclopedia of options. It's not a real fun read. Look at this Russell breaking higher right here. There's our previous high. See if it can break and hold above that. Markets are all starting to rally. Probably not the best time to put on a real aggressive credit spread. That market would need to fall for that credit spread to stay profitable. And everything's turning around. Look at the lousy NASDAQ. It's just dead. Went sideways. The Dow's trying to break. It's a counter trend, though. So once again, little counter trend. Look for it to break out the bottom. See how many waves that is. Drive 1, counter trend, drive 2, counter trend, drive 3. So we're getting down towards the bottom of these moves. There, we're just trying to drop out one more time on this last wave. Got the previous low here. Doesn't want to go, does it? Russell bouncing off of that previous high, couldn't break through. Giving us a nice little trend right up in here. We'll see what it does. Probably give us a little butterfly pattern right in there, little tiny one. You see up, down, give it all the way back down, up. If it doesn't break and hold above that high, that's what we would look for. Just a little pattern like that. But everything's small in here now. Everything's started to slow way down. That'd be $250 off that wing. It's got to break above and hold above. Hold above that previous high. Break above and hold up there. Otherwise, we'd expect it to flush. Come back down and create the butterfly. If it can hold above there, close and hold. Didn't quite hold above it. Closed right on it. another high right here. This is the one we're fighting against right here, right now. There it goes. It's going to hold. If it does, we'll go up and test this next one. You got this area of support right in, or resistance right in here too. You have to be mindful of. There, it's holding above. There it goes. Got 11 seconds. It's going to hold this time. It's going to make it. So this can go away. Just trying to get above the VWAP. So see how we talked this morning about the VWAP? Just going above and below, above, bounced off the VWAP, back above and below. So the VWAP is this line right here. It's just kind of bouncing across the VWAP. So it's not bullish or bearish. It's very neutral today. It didn't get bullish and stay above the VWAP. What you want to see is you want to see it stay above the VWAP. So the idea of the VWAP is you get a VWAP line that goes like this. And a bullish market should look like this. It should come up and it should never go back below it. And all these little points, these little pullbacks should always be above the VWAP. And these are all buy points in here because it's bullish and you're looking to pick up these rallies above the VWAP. But when the market continually just sits here and goes back and forth across the VWAP like this, which is what it's doing today, we're not either bullish or bearish. So you can't get any established trend. There's not really anything to sink your teeth into. It's just neutral across that VWAP. And that's how VWAP's considered bullish or bearish, tells you where the market's bullish, bearish, or neutral. So, there's lots of tools that have been designed to help you this. And so if the market could come and do something like that, stay below the VWAP, then you'd consider the market to be bearish. And then each time you get a pullback, that would be a sell, a sell, and a sell, as opposed to the buy, the buy, the buy. But when it goes back and forth across the VWAP like that, it's neutral. And that would be a good time to put on a real wide iron condor. You could put on your iron condor and collect premium on both sides as this market just dies. But if you want to trade it, you need a little bit more oomph. You need kind of a market that pushes a little harder, stays above those green dots longer than just, because if you get in right here, on a break above the previous high or the first high right in there. Well, by the time you get your stop moved up to break even, the market's turning around, coming back down, and just going to not stop you out with a break even trade or a small loss. And it just sits there and goes back and forth across that average true range, and you never do make any ground, just lose money. Little bit, just cut by a million deaths as it keeps coming in and stopping you out and going and bouncing and stopping you out and bouncing and stopping you out. You need kind of a market that's got some, we call it parabolic, a little volatility to it. These little snaky markets are really hard to trade. They look easy in hindsight. You're like, oh, rich, rich, rich beyond my wildest dreams. But then they realize they're not that easy to trade because they never do. They got lots of topping tails and bottoming tails, and they keep stopping you out because the market's just got no motion to it. That's why these little option strategies are pretty nice, because you can kind of sit on them for a little while and put them a long ways away from the market and just let time decay go and not worry about the little small moves. But they're slow. I mean, this one here, we're only up $17 on it, right? So we could receive 322 by days in. This is 0 DTE. So as long as it stays below that yellow line, right? It's got to just stay below that red yellow line anywhere down here. You'd make your full $322 by the end of the day. Well, no, because you got to pay your premium of $150. So 322 minus $150. So about $150, right? So you make about $150 after sitting there all day waiting for it to decay. And you took a pretty good risk, because if it closes 1 penny above that line, you lose it all. You lose your max loss. Well, I'm going to call it a day, guys. We're going to let this thing run for a little bit. We'll let it see if it takes it off. But I'm in a bad way today. Lands December 4th, 775. That's what I get for trying to take such big positions on the NASDAQ right out of the gate. Last time I had a big losing day like that, it was same reason. Try to trade that NASDAQ first thing. Lesson here, don't trade the NASDAQ as your first trade of the day. Try and build up a little bit of green on a smaller market before you go for those great big huge markets, because man, you get stopped out a couple of times. It's a nasty hit to your portfolio. All right, so that's how our November ended up. Still not the greatest, but still had a positive $4,000 that one day. Then that's how it goes oftentimes. One day will oftentimes be your biggest. You'll have one really good day. You have a whole bunch of tiny days, and then you have one really good day. That was a nighttime. That was a Sunday morning trade. But these were all our little scalps that we were playing in the mornings. But nonetheless, we're on to December and already starting December off with a bad day. But we learned something today. We learned about option spreads, and hopefully you guys can put some of those on and make a little time decay money, because that's a nice way to do it too. All right. Okay, if you have any questions, let me know, and we will catch you guys again tomorrow. See ya. Have a good day. See you guys in class, those that can make it tonight.